Photronics is a leading manufacturer of photomasks which are used to transfer tiny circuit patterns onto semiconductor wafers, often used in flat panel displays. Over the last 12 months, this small cap stock has reported just under $900 million of revenue, $138 million of net income, and $173 million of free cash flow. So, with a market cap of $1.8 billion, the valuation looks extremely attractive. The company trades at just 13 times earnings, under 8 times free cash flow, and under 4 times ebitda. That's especially cheap when you consider the high multiples applied to other semiconductor stocks right now. And it's not like Photronics isn't growing. Revenue over the last 5 years has grown at a rate of 11% a year, with Photronics gaining a 30% share in photomasks, and that market should continue to expand thanks to exploding trends such as AI, electric vehicles, and the Internet of Things. But although 3.8 times ebitda seems incredibly low, it's not actually unusual for Photronics. As you can see from the chart, the company has traded at even lower multiples in the past, and that's largely due to high depreciation charges. Photomasks require a large amount of technical work and capital investment to match customer specifications. As a result, Photronics averages significant capital expenditures, around 17% of revenue. In other words, Photronics needs to keep reinvesting capital just to stay still, and that ultimately affects free cash flow generation and earnings. Free cash flow right now looks good, but that's because the company has strengthened pricing, and this actually highlights another risk. Semiconductors are notoriously cyclical, so if Photronics has to walk back price increases, or if the company sees soft demand, those free cash flow margins could easily revert back towards their historical average. Management thinks that pricing can hold, and there's been talk of growth in the EUV market as well, but it's hard to know how important that will be for the company. So despite Photronics being a complicated business, the case for Photronics stock is actually quite simple. If the company can maintain free cash flow margins in the region of 15 to 16%, revenue only has to grow a few percent a year for the stock to generate significant annual returns. But if margins drop back to a more typical 7 or 8%, the stock may even be slightly overvalued at current levels. Given the nature of the industry and the risk of larger semiconductor companies with scale building out their own capabilities, Photronics stock probably isn't quite as attractive as it first looks. But these are my personal opinions, not financial advice, and I hold no position in Photronics. For more investing videos, make sure to visit my website at 3minutebreakdowns.com. Thank you for watching.